What are collective action clauses, CACs, in debt restructuring? Imagine trying to change the rules of a game when everyone is playing by different agreements. That's similar to what happens in sovereign debt markets without collective action clauses. These clauses are special rules added to bond contracts that help countries and their creditors work together during tough times. They make it easier to agree on changing debt terms when a country faces financial trouble. Before collective action clauses became common, changing debt agreements was very difficult. Every bondholder had to agree to the new terms, which meant one or a few holdouts could block the entire process. This often led to delays or even complete failure of debt restructuring efforts. Countries in financial crises needed a better way to get everyone on the same page quickly. That's where CACs come in. They let a supermajority of bondholders, usually at least 75%, approve changes. Once they agree, those changes automatically apply to all bondholders, even those who voted against them. There are two main types of collective action clauses. The first is the collective modification clause. It allows the majority of bondholders to agree on new payment plans, interest rates, or maturity dates. This makes restructuring smoother because everyone is bound by the majority's decision. The second is the collective acceleration clause. It prevents individual bondholders from demanding full repayment immediately after a default unless a certain percentage agrees. This helps avoid chaotic legal battles and keeps the process orderly. These clauses gained popularity after the financial crises of the late 1990s and early 2000s. For example, when Argentina defaulted in 2001, bonds lost about 70% of their value. The crisis showed how hard it was to coordinate bondholders without CACs. Since then, many countries, especially in Europe, have included CACs in their bonds. During Greece's debt crisis in 2011 and 2012, a retroactive CAC helped secure a supermajority agreement that was binding on all Greek bondholders. From a broader view, CACs mark a big step in the evolution of global financial markets. They shift the power away from holdout creditors and toward collective decision-making. This makes debt restructuring less contentious and more efficient. It also reduces the chances of lengthy legal fights and helps countries recover faster from financial distress. For creditors, CACs mean less risk of being blocked from restructuring plans. For countries, they mean a better chance to regain stability without resorting to costly bailouts. Overall, collective action clauses are a key part of modern sovereign debt agreements. They reflected lessons learned from past crises and help keep the global financial system more stable.